Hey traders, I'm Delgado, Market Insights commentator at Global Prime Forex. As you can tell, I am not resting. This is a long weekend and I hope that you guys are doing great and that you're enjoying with your family wherever you are in the world. But today, I really thought that it would be a great opportunity for me to put together this video presentation, which is going to be a deep dive into the reliability of the smart money tracker, which is one of my cornerstones to assess the market conditions, as I really find it to be an excellent gauge of the actual market momentum. Okay, many of you have been asking me what's what's the whole deal about this smart money tracker, and I would say at least 50 of you have been reaching out to me through Discord asking if I could share this indicator, which has been, it's been a no problem whatsoever. That's what I've done for those that have been asking me, and I will continue to do so if you join our Discord room, which you can find the link down below. That's not a problem, as I said. So today I'm going to be looking at as I said, the reliability of this smart money tracker, but that's just going to be the beginning. I will also be giving you some extra tools that you are going to be needing if you really want to increase the accuracy in calling the right directional biases like a pro. Okay, so today's order of business is going to be split into 3 different categories. The first one is one where I will be making the case as to why the smart money tracker as a standalone indicator is so powerful when applied to the larger time frames. And in today's example, I'm going to be concentrating on the 4-hour. Okay, so here we have the Euro US dollar. It's the market that we're going to be looking at from the 4-hour perspective. In the second window, we have the smart money tracker. Okay, so once I've proven the actual reliability to get us on the right side of the market, which as usual, as I said, I'm not going to be cherry picking specific dates, but rather I'll go through the entire year of the Euro US dollar up to date. Okay, and once I've done that, I will then be moving into the second category or the second phase, which is going to be how we can determine market structures, okay, in a consistent way, how we are potentially being in a position to always be calling a market as trending or ranging. Okay, the reason that I want to go through these structures also is because it is another vital element not to be caught on the wrong side of the market. Okay, and so in this presentation, in these exercises that I will be performing, it would really, as I said, as part of the phase 2, it would come down to continuously answering the following question: are we trending or are we ranging? And in the last phase, phase 3, that's when we are going to go full circle by combining these 2 elements, that is momentum expressed through the smart money tracker and structures. Okay, now if you are able to perfect your game and to keep getting better at the directional biases, you will notice a significant improvement in your accuracy rate on calling the right directions of whatever market that you are trading. Okay, remember that trading when knowing the right market context is absolutely huge, as you really increase the odds in a very massive way to be swimming in the right direction of the current or on the right direction of the flows. Okay, so when you hear me as part of my daily analysis that I put out there, that this is a market, for example, that it is to be bought on weakness or it's to be sold on strength, it is precisely because certain directional dynamics have been identified that increase the possibility of calling that direction correctly. Okay, and it is therefore my intention that in today's presentation I can prove this point. All right, so let's get into this phase 1, which is the magic of the smart money tracker as a standalone indicator to call the right directions in the market. In this case, this is the Euro US dollar. Okay, and by the way, as I said, if you like to get your hands on this indicator, please join us in Global Prime Discord room. In the description box you can find the link, and I can make it available to you. Okay, remember that this is going to be a 4-hour chart going back to the beginning of January. Okay, I've discounted the first week of January because, as you may have guessed, I don't want to be accounting for price action that goes before January the 6th, which was the first Monday of the year. Okay, so just to be exact, I'm going to be, as I said, I'm going to be scratching the January 1, 2, 3. Okay, because, as I said, everyone and his dog is out of the markets at that point. Okay, so as you can see here, let me just expand this window. Okay, so as you can see here, what I've done is I have marked with a vertical line every single time that we had a crossover in the smart money tracker. Okay, the blue indicates bullish momentum, while the red indicates bearish momentum. I've calculated then the aggregated returns by simply pretending that I would enter the market whenever we get a trigger signal, and the total return so far this year by acting in a way that I personally would never enter at such a pricey location, but the total return is 15.5%. Okay, you can actually do the math yourself, but I've calculated all these numbers is 15.5% for the first 3 months of 2020. Now, bear in mind that the explosion in volatility has been at the epicenter to help us, to help this indicator be thriving the way that it has. And it won't always be the case. That's the reality, okay? Unless we also start to account or factor in structures to keep us safer when the market conditions turn more flattish, okay? Which is the main killer for most traders that are going to be marrying to such a simplistic model like just a crossover, okay? It might actually be working for a while, but eventually you will see that that's going to be the demise of traders, just because they see that it works for, let's just say, 3 months, and then it stops working, and it's a vicious cycle. It's a vicious loop that they get into, okay? So, as I said, this kind of approach is not going to be working over the long run, just to be precise enough. So just to call the markets, you really need a whole new level of sophistication, okay? Which is why phase 2 is going to be so important, as it also involves the right interpretation of market structures, which will then allow us in the phase number 3 to combine both for what you'll notice to be some great and consistent calls in the market, because that is the time when we can finally combine it. But in the phase 1, I really just want to make a point, which is that despite you don't want to actually take an approach where you're just going to fully rely on this smart money tracker, it is so far over 10 years of experience trading the markets, it is so far the best gauge of momentum in the market. Okay, the way that I've deemed, or I've described this indicator as a smart money tracker. This is just a fancy term for me, just to understand that we are going to be on the right side of the trend, and that's why you actually refer to this indicator as the smart money tracker. It could just be called anything else, okay? But you can really tell here that you can see. Let me just start expanding here, so that you can notice that these are the actual turns, okay? So whenever the red dot goes above this black line, then we go long. Well, we'll go long. This market turns with a bullish momentum, and then whenever the dot goes below the black line, this is a market with a bearish momentum, okay? And you can see here that we turn bullish right here, then we start going bearish, and you can see how reliable it is. Like it takes us on a bearish momentum phase from January the 17th to January the 30th, so about 2 weeks. Then we turn bullish. Again, the dot goes below the black line, and here it goes from February the 4th all the way to February the 21st. Okay, so that's about almost 3 weeks of price action going to the downside. And again, here it goes from the February the 21st all the way to February the 21st to March the 10th, even longer. Well, no, about the same length as the prior trend, okay? And then it turns lower, and it goes for a protracted period of time, and wash, rinse, and repeat, okay? Here it turns bullish momentum, bearish momentum, and for the last 5 days, ever since April the 7th, we've turned bullish, okay? And so essentially what I've done is, at every single turn, I've painted either a green or a red box depending on the direction that the smart money tracker is calling, and I have accounted for the potential return that one would have achieved if just essentially entering a market order whenever we see the crossover, okay? And other than the very first call that was wrong. So essentially here you can see that the crossover occurs right there. So you would enter a long right there, and then one gets to be stopped or just essentially leaving or exiting the position for a 0.3% negative return, which has been registered up there, so minus 0.4% or thereabouts. The rest of the calls have been positive. Okay, so here notice that the crossover goes lower and we net about 0.3%, which has been registered on top of this box, and so forth. Here it got 0.3%. Here we have the crossover and it goes down for 1.1% or thereabouts. Okay, so I've done all the calculations. You can see here the full string of calculations, and when accounting for every single return that one gets through the crossover, the total returns is about 15.5%. Therefore, as part of phase one, it does confirm the hypothesis that this indicator, as a standalone expression of the momentum, does have a positive expectancy. Okay, now we're going to be moving into phase number 2. Alright, so this is the exact same chart, but rather than just marking the vertical lines, now what I've done is I have drawn a bunch of lines, which is going to determine the type of market structure that we are seeing. Okay, so this is where it identifies, as I mentioned before, the key pivot points in order to understand whether or not we are either trending or we are in a period of consolidation. A trend would be confirmed if in any instance in the chart we are having higher highs or lower lows, while a consolidation or ranging market, which is absolutely crucial to minimize the times that you will be treading water without a clear direction, it's going to be measured by the following condition, which is whenever we have equal or relatively equal highs or lows in different time sequences at a time that the 13 weighted moving average is flattening, that's the confirmation that the market is going to be into or heading into entering a trend, entering a range. Entering a range. Okay. Also note that one can also use the upper or lower band of the Bollinger Band indicator because this is one of the other measurements that I've been promoting as part of identifying a range. Okay, so with that said, let's look at how this market has been unfolding ever since the very early January. I really want you to get a sense. We might not go through every single swing here, okay, because obviously that involves a lot of screen time, but this is basically what I perceive. Okay, so we start by having this impulsive move to the downside, and here we obviously are having a higher high. So at this point we are confirming here a bullish structure, which gets invalidated the moment that we break this low. So at this point now we're having a bearish structure. Let me just repaint that in another color. Okay, so here we're having a bearish structure, and you can see here that we break this high, and now we're starting to have a bullish structure right there, which then gets invalidated the moment that we have a break, but then gets regained again here. Okay, so you can start to get a sense of how I'm calling these directions. Okay, so whenever we have lower lows, then we're going to be recalling a market as to entering a downtrend, which is going to be happening right there. So here we have a low, we have a little bit of a bounce, and then we break into lower levels. Therefore, this becomes a market that enters a bearish phase, a bearish trend. Okay, now how can we call a market that goes into a range? Well, as I said to you, this is going to be based on, and notice here this phase. Okay, as an example, here we had lower lows, which then get invalidated by the fact that we are having a break towards the upside that takes out this prior swing high. Therefore, here we're starting to develop a potential bullish reversal into a bullish trend. Now, notice that after that happens, we have one low and a second low in different time sequences. So what's next is that we want to see a flattening of the 13 weighted moving average, which is this thin black line, which happens around this point. So at this point, that's why I've highlighted this area, this rectangle in orange, because you don't want to get involved in these markets, okay? Whenever we have a flattening of the 13 weighted moving average, and we have been able to spot in the chart an equal high or an equal low, okay? Double equal highs or double equal lows, which was the case, right? So after that happens, we have eventually a resolution of this market through this candle, and this candle indicates that the market now is ready to start trending towards the downside, okay? And the process continues on and on and on and on, and here we can see that we have the first breakout of a structure by violating this prior swing high, and so we are now in a position to start calling this market bullish. That gets invalidated the moment that this prior low gets taken out, and here we begin a downtrend, okay? This downtrend then continues to evolve all the way for, as I said before, in phase 1 for about 3 weeks, okay? So this is a downtrend which was actually confirmed from a structural perspective the moment that we had an acceptance of prices below this prior swing low, okay? And as you can see here, it got us into a very, very juicy range to trend to the downside, okay? Now the only instance that you would have had to have a little bit of cautiously prudence here is when the smart money track, when the 13 weighted moving average goes into a little bit of a flattish period for just one single candle, but it does go, and since we are not able to guess what's going to be happening in the future, right there, here, notice here that it is starting to go in the very last candle flattish, and we actually can call this market as having had double lows in different time sequences. So when that's the case, for even if it was just very short-lived for just one single candle, at this point I would have been cautious, okay? Because the market was entering a range, and that's why I highlight that in an orange box. But then we immediately break and we continue lower and lower and lower, and even though here we have a transition where it looks like we might be ranging, notice that the 13 weighted moving average, by me placing the cursor on top of it, it never really goes flattish. It just continues to be with a downward slope, which is going to then invalidate for now the actual calling of a range, okay? Here finally we have a market that goes into a flattish 13 exponential weighted moving average, or it just reverses altogether. And if we are able to then call double lows or double highs, then we know that we are as part of a range, and we don't want to get involved in this type of market dynamics until we see finally that we are breaking the range, which happens in this upthrust candle, okay? And it continues. I mean, it's very repetitive, okay? So here we have an absolute monster move to the upside, and the only time that the 13 weighted moving average is going to be turning from an upward slope into either flattish or reversing is at this point in time, okay? Notice here that if I place the cursor, you will notice that right at this point in time we have a turnaround of the 13 weighted moving average. So we need to ask ourselves, do we have double highs or double lows? And we did have double highs, and then here we had double lows. So the moment that it turns around, we know that this is going to be the top side of the range, and here becomes the lower bound or the lower end of the range, okay? And then the conditions continue towards the upside because we are breaking the range. And eventually we have this final run to the downside. We have a little bit of a recovery, which then gets us into a bearish trend at that point. And finally, we've had a bullish trend ever since we had this breakout, okay? Because we did enter a range right here, which was highlighted through the orange box. The 13 weighted moving average was turning around, and we had double lows, we had double highs, so we had to actually wait for a market that was decisive enough to be closing a 4-hour candle outside this range, and that was what occurred, okay? So ever since we've been in a bullish trend. And that's the explanation of phase 2, which is calling market structures. Okay. All right, so here's where we're gonna go, as I said, full circle. This is phase 3, and that's where we are going to overlay momentum with a structure, only engaging when we have sufficient evidence that the market is trending in the context, as I said, of momentum and structure. Okay, so in the chart, what I've done, I've highlighted all the periods where momentum and structure are matching up by a green or a red box. Okay, it is only in the instances that we have momentum and structure in the right dynamics, you know, providing us the same signal, the same direction, that we are going to be calling a potential direction through these green or red boxes. Okay, it is as I said, within these boxes that I've painted, where as part of you will notice that as part of my daily technical analysis, I tend to stress that the chances are that we could be spotting opportunities potentially to engage in a market that is at a discount if we see a dip within an uptrend, or alternatively if we see a bounce within a downtrend, we might be spotting a sell side opportunity. Okay, so the whole thing originates from this type of analysis that I am providing to you today. Okay, I'm teaching you today. Okay, so now each trader will have a different interpretation of where and how to enter positions in the lower time frames, and for argument's sake, what I've done is I essentially just been keeping this 13 weighted moving average, which helps us a lot to identify when the market enters a range. And so this moving average is also going to serve us to call where in the chart the price enters a discounting location, a location where it is perceived to be technically attractive to actually be engaging in a trending phase. Okay, and the results would definitely be fascinating. They would fascinate you. Okay, because in the phase 1 I was just calling that whenever we have a crossover, we can obviously engage in shorts here and then go longs, but through the whole entire phase here, which for example lasts from February the 21st all the way to March the 10th, there are many opportunities that one can actually spot in this market. Okay, it is not just about getting into this market whenever there's a crossover. You would be undermining the potential that you have as a trader to be calling this trend day in and day out with very, very high precision. Okay, so what we're going to be doing as part of this phase 3, which goes, as I said, full circle, is we are going to be also using this 13 weighted moving average, because whenever the price returns towards it, that's what you potentially could consider a discount. Okay, you could have different measures, you could have different approaches, but this is just simply for argument's sake. Okay, hopefully you get the whole concept, which is momentum, structure, and then try to get in a market whenever it is trending and you have a discounted price. It could be you basing that decision on getting involved below the opening price if we are in an uptrend, or above the opening price if we are in a downtrend. Okay, but I digress. So what I'm going to be doing here is remember that this very first uptrend, it was called wrong. So we really never had any momentum. Okay, well, it really depends. I mean, if you are a 5-minute time frame trader, obviously this was a little bit of a bounce here for about 13 to 15 pips, so you never know what kind of approach every single trader is going to have, so that can obviously alter the results. But I digress. So here we have a break of structure and we had the turnaround in momentum. So it is through this, through the length of this red box, that you would be looking for short opportunities. Okay, and what I've encouraged is that rather than you just essentially blindly getting into a market whenever we have a crossover of this smart money tracker, you really want to find that we have, as I said, the agreement of the structure plus the momentum, and we are offered some type of discount in the market. And as you can see, this is the type of trading that I will always encourage. Okay, you already have a market structure that has been confirmed or validated to be in a bearish dynamics. We have the crossover. Here we have the Goldilocks, and so based on this context, if we are now approaching, let's just say, the 13 weighted moving average, which is a nice technical discount as part of this new bearish context, then we want to engage. And notice here that we had a major run towards the downside. Then we go into a little bit of a range, and we can start asking ourselves the exact same questions, which are, okay, do we have a break of this range? Yes, we did, through this candle right here, okay, through this candle. So whenever that's the case, and then we have that the smart money tracker, the momentum is now in favor of the bulls, the structure has been broken. If the 13 weighted moving average, again, as an argument say, you could be using the 8, you could be using the 20, up to you, okay? You could actually just be engaging below the prior day's opening price, okay? It depends, sorry, below the prior day's closing price, it depends, okay? So here we have another bounce, which is successful, and here are the locations in the chart that, as part of my daily technical analysis, you will notice that ahead of time I'm gonna be of the opinion that this looks like a market that, based on this momentum and this structure having turned to the upside, the odds are in favor of those that are going to be engaging in deep buying strategies or in a deep buying campaign. And that is exactly how that is being translated in the chart. Okay, we have that retracement, and then we have the continuation, the follow through demand. Okay, so that's what I am always trying to identify and assisting you clients of Global Prime to really be in tune, be better equipped with the markets that you are going to be trading, because this is something that you can extrapolate to absolutely any market. Okay, so we then continue, and we have a break of structure right there, and it is almost at the same time that we have this synchronicity between the smart money tracker turning lower. So that is telling us that there has been enough ebbs and flows that are now putting us in a position of conviction, or position of confidence, that this market has finally gathered enough steam to then turn around. And we have the final confirmation by the market then breaking the structure through this candle right there. Okay, so whenever that's the case, then we want to be in a position to be selling on bounces. Here looks like it was a little bit of a stagnation. It never really eventually worked out. You obviously need to be accounting also for what type of high impact news we have. Perhaps here we had central bank decisions, so always be on high alert for those type of decisions. Okay, so then we go through a little bit of a range, and here is where we are once again on the money, calling for a great trend, which is actually the smart money tracker never turned to the upside here, so the momentum was still in our favor. And here we just needed to see that there was a resolution of price through the lows of this range, which had been confirmed through the flattening of the 13 weighted moving average at a time that we had equal lows in multiple occasions. So notice that the market here comes and retests the 13 weighted moving average, and in multiple instances the same thing happens. Okay, so again, going back to January the 24th, is it January? Let me just check that. Yeah, so going back to January the 24th, if you were to read my daily technical analysis, you would notice that it, as part of my conclusions, I would have then suggested, which is never going to be fixed in stone and is never going to guarantee that you're going to be getting the directions right all the time by any stretch of the imagination, but you will notice that I would be promoting the idea that there is sufficient evidence that this is going to be a market that every single time we have a bounce is going to potentially be sold on that strength, on that bounce. Okay, and that is essentially here what's happening. So rather than just someone who wants to enter on the break and then just holding the whole trade until the end, here you have opportunities to actually engage in a market several times, over and over and over. Okay, So as we continue towards February, we are ending January, we have a break of structure, we have the turnaround of the smart money tracker, and once again the first retest of the 13 weighted moving average proves to be a great discounting price for the buyers to actually step in and then drag this price all the way towards the 1.11 right there. Okay, so again, this is not something that I'm making up, but rather I am walking you through the entire data that the euro US dollar has captured ever since the beginning of the year. Okay, so here we have a break of structure, and the same thing will be occurring. So at the risk of obviously sounding as a broken record, I'm just gonna give you again the examples as to what kind of tactics you could have used, or what kind of strategy you could have deployed to actually engage in this market, which is, look, if we know that we've broken structure, if we know that we've turned around in the smart money tracker, then we want to only be sellers, but sellers not at any price. We want to be sellers at a price that is attractive enough, what we can anticipate that is going to be drawing enough interest from those that are dominating the flows, in this case the sell side flows. So we have one instance here where the 13 weighted moving average gets tested, second time, third time, we go through I may have missed this range, okay, but you get the point. Okay, so we go through more opportunities, and again here, you know, another one, you get the point. Yeah, okay, and this trend terminates the moment that we enter into a range through the flatness of the 13 weighted moving average, and then we have a break of structure. Okay, so whenever we have the break of structure, then again you want to engage at a retest, or even better at a break of this 13 weighted moving average. That really is telling us, hey, at these prices we are having a discounted price in the context of a bullish trend. Same here, same here. Let's keep moving forward. Same here, same here. Range. Let's keep moving forward, sorry. Okay, let's keep moving forward. Doesn't quite touch it here, gets very close. Okay, and then here we get the break of structure. And so, wash, rinse, and repeat. We are in a bearish trend. We know that the momentum is to the downside, so we want to engage at the 13 weighted moving average as one measure that would put you in a very good position to actually be you know, riding this trend, jumping on the bandwagon of this bearish trend. Okay, joining the bearish party. We have a little bit of a range here, obviously being expressed through the flatness of the 13 weighted moving average, and knowing that we can actually here find that in different time sequences we have double highs, but then we break. We do break, and then 13 weighted moving average, 13 weighted moving average, okay. Let's keep moving forward. We've gone through pretty much all the data that is available, I think. We still got another month left, okay. Okay, so eventually we did print a range here, double highs, flatness of the 13 weighted moving average, and then we break the structure through these candles. There's acceptance above. 13 weighted, 13 weighted, 13 weighted. Through this period, you will notice that my daily edge reports are going to be suggesting the idea that as part of your trading approach for the next 24 hours, you want to most likely be in a position to be a buyer on dips. Buyer on dips means that whenever the price approaches whatever discounting, whatever perception you have about discounting prices, then you engage. Today, 13 weighted moving averages is the one that I want to give you as an example, which works like a charm really, really well. Okay, so let's keep moving forward. Break of structure finally being confirmed right there. So once we have the break of structure through this candle accepting below this prior low, then we know that we can start engaging in the retest of the 13 weighted moving average. Right there, right there. Then we go into range, and then we change into a bullish structure, which I believe is the current phase we're at right now. So through this breakout, which occurred on April the 7th, we knew that once we were touching or going below this 13 weighted moving average, this would be perceived as a potential buy side opportunity by those that have been able to identify the right flows, the right current of the market, which is buy side bias, as long as we don't have, once again, a turnaround of the smart money tracker and we have a break of structure. For now, what we have is the two elements that are supporting this buy side bias, okay, the bullish structure. That's why here, to me, and I was actually promoting the idea, as I said, of buy on dips on the euro against the US dollar. You can go back to my videos, which I do publish every single day, and you will be able to keep me accountable about these calls that I am making to you. Okay, so hopefully this is a very informative video. I've been receiving a lot of questions about the smart money tracker, and today I just wanted to go the extra mile. I wanted to clarify to the best of my abilities how I am using the smart money tracker in combination with market structures. Whenever we can combine both of them, we just are left with the final question, which is, can we find a discount? And then it is up to you. It boils down to the specific makeup of a trader, the specific profile of a trader, to understand what do you perceive as a technical discount. Okay, there could be hundreds of different approaches. Today it's only one approach, and that is through the 13 weighted moving average. That would give us a little bit of a idea that we are getting discount as part of this context. So if you have found value as part of this presentation, I'm asking you to help me grow this channel. I'm asking you to really smash that like button, make comments down below, join me in the Discord room, ask me if you still don't have available the smart money tracker, and let's keep growing. Let's keep educating more and more traders. I really want to put out there education that is actually it is objective, that it is proven to work, and that it is going to be actionable for you going forward. You need to stick with, at the end of the day, you need to stick with some type of strategy that you are comfortable with. This is one, these are the tactics that I'm using to call the direction. Then it's a whole different way to then define what is your ultimate trigger mechanism that will allow you to get into the market, get out of the market. But hopefully that half part of the equation that is about, hey, what kind of context are we trading? Hopefully this is something that I've been able to get to clarify to you today. Okay, so with that being said, I beg you all to, and I'll see you again tomorrow with another educational video about the financial markets. Cheers.